Okay, let's unpack this. Have you ever wondered why some traders consistently make money while others seem to just, well, struggle?
Yeah, it's a common question.
Or why, even with all the market data, like right there at our fingertips, our minds sometimes trick us into making, let's say, less than ideal financial choices?
What's truly fascinating here, I think, is that the answers often lie not just in crunching market numbers, but really in a profound understanding of risk management and the intricate workings of our own trading psychology.
Ah, so they're connected.
You could say they're two sides of the same very valuable coin when it comes to navigating the markets. You really need both.
Okay, so today we're taking a deep dive into a comprehensive module on exactly this, risk management and trading psychology from Zero to the Varsity.
A great resource.
Our mission here is to basically pull out the most important nuggets of knowledge from these materials, give you a shortcut to being well-informed on these critical topics, hopefully with some surprising facts and, practical, actionable takeaways.
Yeah, and we'll explore the rigorous sort of quantitative methods for understanding and managing risk, but also alongside the surprising and sometimes, frankly, quite humorous insights into what happens in our own minds when money's on the line.
Right, because money does funny things to the brain.
It certainly can.
So, at its core, for every potential profit in the markets, there's an inherent risk of loss. That's the game, right?
Absolutely. No way around it.
And the difference between the consistent winners and maybe the consistent losers often boils down to truly understanding and managing that risk, plus disciplined money management. Mark Douglas, the trading psychologist, he put it really powerfully. He says successful trading is 80% money management and only 20% strategy.
80%. That's huge. It really underscores the point.
It really does. So it's not just about picking the right stock.
Not at all. And risk, it's far more than just the probability of losing money. When you invest, you're primarily exposed to two fundamental forms of risk: unsystematic risk and systematic risk. So unsystematic risk is company specific. Think of things like the business prospects deteriorating, maybe profit margins declining.
Like management making bad calls.
Exactly. Management misconduct, or maybe just intense competition suddenly cropping up. It's unique to that one company.
Gotcha.
A really vivid example was a major corporate accounting scandal back in 2009 involving a large tech company. That company's stock price just plummeted drastically.
Right.
But its competitors and the broader market indices, they were not impacted in the same way. So that really highlights how unsystematic risk is kind of confined to that specific firm.
So if a single company can take such a massive unexpected hit like that, how do you protect your overall portfolio from that kind of, company-specific shock?
Yeah, that's the crucial question. And that's precisely where diversification comes in. It's the classic don't put all your eggs in one basket idea. So instead of putting all, say, $100,000 into a single tech company, you could invest maybe half in that tech company and half in a completely different sector, like a financial institution.
Okay.
If the tech company's stock then declines, well, the damage is only to half your investment, not the whole thing.
That makes sense. Is there a magic number of stocks for diversification?
Well, research suggests that for most investors, holding up to around, say, 20 to 25 different stocks provides the necessary diversification effect. After that point, the benefit of adding more stocks in terms of reducing unsystematic risk, it tends to flatten out.
Ah, okay. So diminishing returns after about 20 or 25 stocks. Interesting. It's like buying extra umbrellas when you already have 5. Focus on the quality of diversification, maybe, not just the sheer quantity.
That's a great way to put it. But then what about those broader market movements, the things that seem to impact everything?
Yeah, the tide that lifts or sinks all boats.
That's systematic risk. This is the market-wide risk affecting virtually all investments. It arises from common factors like slow economic growth, rising interest rates, inflation, maybe geopolitical instability, stuff that's outside any single company's control.
And you can't diversify that away.
Right.
Because it hits everyone.
Exactly. Unlike unsystematic risk, systematic risk cannot be diversified away. It's inherent in the system. However, and this is key, it can be hedged.
Hedged, like insurance.
Kind of. Think of hedging like carrying an umbrella on a cloudy day. You don't know if it'll rain, but if it starts pouring, you open it up and you got some cover. Hedging strategies aim to provide that cover against market downturns.
Okay, so just to be clear for everyone listening, Diversification handles the company-specific stuff, the unsystematic risk.
Right.
And hedging helps manage the market-wide stuff, the systematic risk. Two different tools for two different jobs.
Precisely. And it's absolutely crucial to remember, no investment is ever truly 100% safe. Risk is always part of the equation.
Right. Okay, so with that foundation of risk understood, let's talk about the flip side, what we actually hope to gain, expected returns. And it's important to clarify, this isn't a guaranteed return, is it?
No, not at all. It's a probabilistic expectation, like predicting the average outcome. If you rolled a dice many, many times, you expect an average of 3.5, but you won't roll 3.5 on any single throw.
Good analogy. So how does that work for a whole portfolio?
Well, the expected return of a portfolio is essentially just a weighted average of the expected returns of all the individual assets inside it.
Okay, weighted average.
Yeah. So, for example, if you invest, say, $25,000 in a tech company with a 20% expected return, and another $25,000 in an industrial company with a 15% expected return, your portfolio isn't just 20% or 15%.
Right, because it's split 50-50.
Exactly. So you'd calculate it by taking 50% of the tech company's 20%, that's 10%, and adding it to 50% of the industrial company's 15%, that's 7.5%.
Giving you 17.5% total expected return for the portfolio.
Precisely. The formula is ERP equals W1R1 plus W2R2, and so on for however many assets you have. Weight times return, summed up.
Okay, so it sounds like understanding just the basics of risk isn't enough. We need to actually put numbers to it, quantify it. How do we even begin to measure the risk of a whole collection of investments? This is where it starts to get really interesting, I think.
It certainly does. First, we use a concept called variance. Variance measures how much an asset's return varies or deviates from its average return over time.
So like how jumpy the stock price is compared to its usual performance.
Exactly. Think of it like throwing darts. Low variance means all your darts are clustered tightly around the bullseye, very consistent.
Predictable.
High variance means your darts are scattered all over the board, much more unpredictable, much riskier. So a larger variance indicates higher dispersion or risk.
And standard deviation is related to this.
Yes, the square root of variance is standard deviation. We often just call it volatility. It's a more intuitive measure for many people.
Okay, that makes sense. Variance tells us about one stock's riskiness. What about how stocks move together?
That's where covariance comes in. Covariance tells us how two or more assets, like different stocks in your portfolio, tend to move in relation to each other.
So do they go up together? Or does one go up when the other goes down?
Precisely. Positive covariance means they generally move in the same direction. Negative covariance means they tend to move in opposite directions.
And which one do portfolio managers want?
Well, generally speaking, smart portfolio managers actually desire assets with negative covariance.
Why is that?
To balance the portfolio and reduce overall risk. The idea is, if one stock takes a nosedive, they want the other one to at least hold steady or ideally even go up a bit. It smooths out the portfolio's overall performance.
Right. So the magic here isn't just knowing these numbers exist, but realizing they're like your secret weapon for balancing things out, almost like a financial choreographer, making sure your stocks don't all trip over at the same time.
I like that analogy, a financial choreographer.
But, okay, if you're building a portfolio with, say, 15 different stocks, calculating the covariance of each one with all the others, that sounds incredibly complicated. This brings me to wonder.
Which leads us straight to the elegance of using matrices. Yes, for multiple stocks, like maybe a 5-stock portfolio, we use a matrix. It's essentially just a grid, a table of numbers.
Okay.
This grid, called the variance-covariance matrix, contains the individual stock variances, their standalone riskiness, right there on the diagonal line.
Got it.
And then off the diagonal, in the rest of the grid, you have the covariances between every possible pair of stocks in your portfolio. So you might see a tiny number, like 0.000034, representing the covariance between, say, a leisure stock and a pharma stock.
Right, but just looking at a grid of tiny decimal numbers, it seems hard to grasp what it all means.
Exactly. On its own, this raw covariance matrix can be pretty hard to interpret because the numbers are often very small and kind of abstract. They depend on the scale of the returns.
So what's more useful?
That's why we really focus on the correlation matrix. Correlation is derived from covariance, but it's standardized. It always ranges between -1 and +1.
Okay, that sounds much clearer.
It makes the relationships much more intuitive. In a correlation matrix, you'll always see ones down the diagonal because a stock is perfectly correlated with itself naturally.
Makes sense.
And then you'll find symmetrical values above and below that diagonal, showing the correlation between pairs. For instance, a correlation of, say, 0.23 between two stocks, like a tech company and a healthcare firm, means they tend to move somewhat in the same direction, but maybe not very strongly.
And if it was close to 1?
Closer to 1 means they move very closely together. Closer to -1 means they move in opposite directions. 0 means no linear relationship.
Okay, this is clicking. So what does all this statistical power, the correlation matrix, the weights, what does it all mean for you, the listener, as you're building your own portfolio? What's the big takeaway here?
It means that with that correlation matrix and the weights you assign to each stock, deciding to put 7% of your capital here, 16% there, 25% somewhere else, and so on, we can actually calculate the overall portfolio variance.
The risk of the whole thing combined.
Exactly. For a typical 5-stock example we might look at, we could find an initial annual variance of, let's say, 17%, maybe with an expected return of 55%.
Okay.
We can also use something called an equity curve to visualize how the portfolio performs over time. This usually starts at a base value, like $100, and it just tracks the daily ups and downs based on your weighted investments.
So you can actually see the volatility.
Yes, it's a great visual check.
Yeah.
And interestingly, you can also calculate the portfolio's standard deviation directly from the equity curve data, and it should match what you get from the more complex matrix calculation. For instance, maybe a 1.1% daily standard deviation.
Right. So different ways to get to the same understanding of risk.
Exactly. And here's where it all comes together with a really powerful statistical concept. Portfolio returns often, though not always perfectly, follow a normal distribution. The classic bell curve shape.
The bell curve. Okay.
And because they often follow this pattern, it allows us to estimate the likely range within which the portfolio's returns will fluctuate, and we can assign a probability or a confidence level to that range.
So you can say, I'm X% sure the return will be between Y and Z.
Pretty much, yeah. Standard statistics tell us that roughly 68% of the time, returns should fall within one standard deviation of the average expected return. About 95% of the time within 2 standard deviations. And about 99% of the time within 3 standard deviations.
Can you give an example with the portfolio numbers you mentioned?
Sure. Based on our example portfolio's expected return of 55% and variance leading to a certain standard deviation we might calculate. Within one standard deviation, that's 68% confidence, returns are likely between, say, plus 37% and plus 72%.
Okay, that's quite a range.
It is. Now, for 95% confidence, 2 standard deviations, the range widens. Maybe it's plus 19% up to plus 90%.
Wider range, more certainty it falls within it.
Exactly. And for 99% confidence, 3 standard deviations, you might be looking at a range like plus 2% all the way up to over 100%, maybe 108%.
Wow.
What's key here is understanding the trade-off. Higher confidence requires accepting a larger potential range of outcomes. And it's also interesting, in a strong bull market, the positive bias might mean even the 3 sigma range doesn't include losses. But the principle is about estimating likely outcome ranges.
That's incredibly powerful. So, okay, we've dissected risk down to its very atoms almost. We can measure it, we can estimate ranges, but knowing it is one thing, actually doing something about it is another.
Absolutely.
For someone listening, how do they take this knowledge and actively manage their portfolio? How do they truly minimize their downside or maybe maximize their upside? This brings us, I think, to portfolio optimization.
Yes, portfolio optimization. It's really all about intelligently figuring out how much capital to allocate to each stock, adjusting those weights we talked about to achieve either the best possible expected return for a given level of risk or the absolute least possible risk overall.
So it's about finding the sweet spot.
Finding your sweet spot, exactly. Take a simple 2-stock example again. Maybe a tech giant with a 22% expected return and a biotech firm with 15%. If you just split it 50-50, your portfolio's expected return might be 18.5%.
Right, the average.
But if you tweak the weights, say, only 30% in the tech giant and 70% in the biotech, your expected return shifts maybe down to 17.1%. But reverse it, 70% tech, 30% biotech, and maybe it jumps up to 19.9%.
And the risk changes, too, with each mix.
Absolutely. Every change in weights potentially changes both the expected return and the overall portfolio variance or risk.
So what are the main goals when you optimize?
Well, this leads us to a few key portfolio types you can aim for. One is the minimum variance portfolio. This is the specific combination of weights that results in the absolute lowest possible risk for that particular group of stocks.
Okay, lowest risk possible. What's the opposite?
You could aim for the maximum return portfolio. This is the combination of weights that theoretically yields the highest possible expected return, but usually that comes with higher risk.
Makes sense. Higher reward, higher risk.
And here's a really crucial point. For any given level of risk between the minimum and maximum, there can actually be at least two unique portfolios. One that gives you the highest possible return for that risk level, and another that gives you the lowest possible return for that same risk level.
Ah, okay. So at the same risk level, you could have very different outcomes depending on the weighting. You want the one giving the higher return, obviously.
You'd hope so.
So how do you actually find these optimal weightings without just guessing and checking endlessly? What's the practical tool?
Well, people often use software for this. Tools like Excel solver function are commonly used. Conceptually, how it works is you tell your objective, like minimize the portfolio variance or maximize the expected return.
Okay.
Then you tell it what it's allowed to change, which are your stock weights. And finally, you apply constraints, like the really important one that all the weights must add up to 100%. You can't invest more money than you have.
Right. Constraints are key.
Yeah. So going back to our 5-stock example, using a solver, we might find that we could reduce the annual variance from that initial 17.6% down to a minimum of, say, 15.5%, but the trade-off might be that the expected return also drops, maybe to 36%.
So you lowered risk, but also lowered potential return.
Exactly. Or, alternatively, we could fix the risk level. Say we're comfortable with 17% variance. The solver could then find the specific weightings that give the maximum possible return at that 17% risk level, maybe 55.8%, and also the weightings that give the minimum possible return at that same 17% risk level, perhaps only 18.3%.
Fascinating. And plotting all these possibilities gives you that frontier.
Yes. Plotting all these different optimized risk-return profiles creates what's known as the efficient frontier. Imagine a graph. The x-axis is risk, standard deviation or variance, and the y-axis is expected return.
Got it. Risk on the bottom, return up the side.
Right. The leftmost point on the curve that forms is your minimum variance portfolio, the lowest risk point. The upper part of this curve, stretching up and to the right from that point, represents the efficient portfolios.
Why efficient?
Because for any given level of risk along that upper curve, the portfolio offers the absolute highest possible expected return. Any portfolio below that upper curve is considered inefficient. You could get the same return for less risk or more return for the same risk by moving up to the frontier.
Okay, so for you, the investor, the listener, what's the core takeaway here? Where should your portfolio be?
The key takeaway is that, as an investor, your goal should generally be to construct a portfolio that lies somewhere on that efficient frontier. It's not necessarily about picking the absolute minimum risk point or the absolute maximum return point way out on the edge.
So it's about your choice along that optimal curve.
Exactly. It's about understanding that curve exists and then aligning your portfolio with your personal risk tolerance, your return goals. You define where on that efficient spectrum you want to be. It puts the power back in your hands, informed by the math.
That makes a lot of sense.
Well,
okay, connecting this back to the bigger picture. All these calculations, variance, correlation, optimization, they're about understanding potential outcomes, especially the likely ones. But what about the really rare, truly unexpected stuff? The black swans, as they say, that can just appear out of nowhere and change everything.
Ah, yes, the black swans, low probability, high impact events. That's where another risk metric, value at risk, or VAR, comes into play.
Value at risk, VAR.
VAR is a metric specifically designed to estimate the potential worst-case loss over a specific time horizon within a given confidence level if one of these rare adverse events were to occur.
So it's trying to answer, how bad could it realistically get?
In a nutshell, yes. Historically, the need for something like VAR became really apparent after the massive, unexpected global market crash on Black Monday, October 19th, 1987. That day shook everyone.
I bet.
It really spurred the rise of quantitative analysts, the quants, and led to the development of VAR by major firms like JP Morgan. They famously created a 4.15 p.m. report that synthesized the firm's total risk exposure across all desks ready before the next trading day.
Wow, a daily what's our worst case scenario report? How do you even calculate VAR simply?
Well, there are complex methods, but a common sort of quick and dirty approach uses historical simulation. First, you typically check if your portfolio's historical returns roughly follow that normal distribution we talked about, maybe by plotting their frequency.
Okay, check the distribution.
Then, you take a history of your portfolio's daily or weekly returns, maybe the last year or two, and you simply sort them from the best performing day to the worst performing day.
Rank them.
Right. Then, if you want the 95% VAR, you look at the worst 5% of those historical returns. The VAR number is the least bad return within that worst 5% group. So, for example, portfolio, maybe the cutoff point for the worst 5% is a daily loss of -1.48%.
So the VAR is -1.48%. What does that mean?
It means that, based on historical data, you can be 95% confident that your worst daily loss will not exceed 1.48%. Or, put another way, there's only a 5% chance that your daily loss will be worse than 1.48%.
Okay, that gives you a boundary for expected bad days. Is there anything beyond VAR?
Yes, there's also conditional VAR, CVR, sometimes called expected shortfall. VAR tells you the threshold for the worst 5% of outcomes, but CVR asks, okay, if we are in that worst 5% tail, what's the average loss we can expect?
The average of the really bad days.
Exactly. So for our example, if VAR was -1.48%, the CVR might be, say, -2.39%. It tells you that when those extreme tail events happen, the average loss tends to be around 2.39%. It gives a bit more information about the severity of those extreme losses.
Okay, VAR and CVR, give us a handle on those tail risks, those black swan type events.
Phew.
You've covered a lot of the quantitative side.
We have. It's dense stuff.
It is. But now, what happens when the numbers are telling you one thing? Maybe your VAR is acceptable, your portfolio looks optimized, but your gut or your emotions are screaming something else. Because even the most perfect risk model can't account for the most unpredictable variable of all, us, our own psychology.
Precisely. This is where the other half of the equation comes in trading psychology.
Let's switch gears and really delve into this fascinating and often, let's be honest, tricky world. I actually learned this the hard way playing poker years ago, not even trading. Yeah, I remember this one night losing about 3,000 rupees, which felt like a fortune then. Got wiped out, rebought, wiped out again. I just kept convincing myself the next hand had to be a winner, so I kept increasing my bets, only to lose more. It was just a brutal lesson in, position sizing and understanding probabilities, or the lack thereof in my case.
That poker anecdote is a perfect illustration of something called the gambler's fallacy.
Gambler's fallacy, okay.
It's this ingrained bias where we believe that a streak, whether it's a losing streak like yours or even a winning streak, is somehow due to end. A trader who's faced, say, 6 consecutive losses might massively increase their bet size for the 7th trade, absolutely convinced their luck must turn around now.
Yeah, that was me.
Or, conversely, someone who's had a string of wins might suddenly get timid, drastically reduce their bet size because they feel they're pushing their luck.
Right. Fear takes over.
The critical point is that in situations with random or near-random outcomes, like often in short-term trading, each new trade generally has the same probability of winning or losing as the last one did. The market doesn't remember your last 6 losses.
So what's the antidote?
The antidote, as you experience the hard way, is disciplined position sizing, not letting emotions dictate how much you risk on any single trade.
Right. And speaking of losses, you mentioned something else, recovery trauma.
Oh, yes, recovery trauma. This highlights just how incredibly difficult it is mathematically to recover from deep capital losses. It's quite stark when you see the numbers.
How so?
Well, if you lose 10% of your capital, it feels bad, but you only need an 11.1% gain on the remaining capital just to get back to where you started.
Right. Okay. No.
But if you suffer 50% loss, you lose half your money. You need a 100% gain just to break even. You have to double what's left.
Wow. Double your money just to get back to zero.
And if you lose 60%, you need a whopping 150% gain to recover. It gets exponentially harder the deeper the hole you dig.
That's terrifying, actually.
It is. And traders, especially maybe those with smaller accounts trying to get rich quick, often take these disproportionately larger risks relative to their capital. They swing for the fences on every trade, hoping for that one big win, but that significantly increases the chance of hitting one of these deep drawdowns that leads to this recovery trauma, or worse, blowing up the account entirely.
So the solution is?
The solution is simple in concept, but often hard in practice. Protect your capital above all else. Stay in the game longer by aiming for consistency, smaller wins, and strictly managing losses. Don't try to hit home runs on every single trade. Survive first, then thrive.
Protect capital.
Yeah.
Stay in the game. That recovery trauma table is genuinely eye-opening. Okay, so this raises a really important question.
Yeah.
If position sizing is the antidote to the gambler's fallacy and helps avoid recovery trauma, how do we even begin to define the capital we're actually working with? And then how do we apply that sizing?
That's a fundamental first step, defining your working capital or equity. There are generally three main models people use. The first is the core equity model. This is pretty conservative. When you allocate capital to a trade, it deducts that amount from your available equity. So your capacity for subsequent trades actually reduces with each open position. It's simple and helps prevent over-leveraging.
Seems sensible. What else?
Then there's a total equity model. This one aggregates everything, your starting cash, plus any open profits, unrealized P&L, minus open losses, plus cash. It basically counts all your current positions, including paper profits.
That sounds a bit risky, counting profits before they're locked in.
It can be risky, yes. It's a bit like, as they say, counting your chickens before they hatch. If those open profits evaporate, your calculation was based on phantom equity.
Right. So what's the third one?
My preferred approach, and one many find balanced, is the reduced total equity model. This sort of combines aspects of both. It reduces the capital available for new trades based on margin used, similar to the core model, but it does intelligently incorporate locked-in profits from existing positions, often those protected by a trailing stop loss.
So it rewards good risk management on existing trades.
Exactly. It encourages basic stop-loss practices and provides, I think, a more realistic, yet still prudent, view of your actual available trading capital.
Okay, so once you've defined your equity using one of these models, how do you decide how much to risk per trade? What are the techniques?
Right, the position sizing techniques themselves. And importantly, these are generally asset and time frame independent. They work for stocks, futures, forex, short-term, long-term.
Okay, versatile.
First, there's the really simple one, unit per fixed amount. For example, you might decide, I'll trade one standard lot of Nifty futures for every, say, 100,000 rupees in my account.
Super simple. What's the catch?
Its simplicity is its major flaw. It completely ignores the inherent riskiness, the volatility of different assets. For instance, Nifty futures might have an annualized volatility of, say, 14%, while Tata Motors futures might be way up at 40%.
Much wilder.
Much wilder. But this method treats them exactly the same, allocating the same capital unit. It doesn't account for the fact that the Tata Motors position carries potentially much larger swings. It also doesn't scale well if the contract value itself changes significantly.
Right, so simple, but totally ignores the actual risk or wildness of different things. That seems like a big oversight.
It is. So next up is percentage margin. Here, you set a maximum percentage of your total capital that can be tied up in margin for any single trade. For example, maybe you cap it at 20%. If you have a 500,000 rupee capital, that means the maximum margin you'll commit to any one position is 100,000 rupees.
Okay, that controls margin usage. Does it fix the volatility issue?
Not necessarily. While it does fix the margin amount per trade, the underlying volatility of the assets you trade can still vary wildly. So you might have the same margin committed, but the actual risk profile, the potential P&L swing, could be very different between trades.
Okay. Better, but still not perfect. What else?
The percentage volatility method directly tackles this. It specifically accounts for the underlying asset's volatility, usually by using something called average true range, or ATR.
ATR, what's that again?
Think of ATR as a measure of how much a stock or future typically moves, on average, over a certain period, like the last 14 days. It captures the typical daily trading range, including gaps.
Okay, a measure of its normal wiggle room.
Exactly. So with this method, you might say, I want to risk no more than 2% of my capital in terms of volatility on any single trade. If your capital is 500,000 rupees, 2% is 10,000 rupees.
Right.
Now, let's say you're looking at Piramal Enterprises, PEL, and its 14-day ATR is 76 rupees. To figure out your position size, you divide your volatility risk cap, 10,000 rupees, by the ATR, 76 rupees.
10,000 divided by 76 gives you about 131.
Right, so you'd buy about 131 shares of PEL. The goal here is to make each position have roughly equal volatility exposure in your portfolio, regardless of the share price or margin. It's quite sophisticated.
That sounds much smarter, equalizing the potential wiggle across trades.
It is. But perhaps the most intuitive, and I think widely used by professionals, is the percentage risk method.
Percentage risk. Okay.
This is very straightforward. You simply define the maximum loss you are willing to tolerate per trade as a fixed percentage of your overall trading capital.
Like, I will not lose more than 1% of my account on this trade.
Exactly. Or maybe 1.5% or 2%. Let's use 1.5%. If your capital is 500,000 rupees, 1.5% is 7,500 rupees. That is your maximum acceptable loss for any single trade.
Okay, that's my line in the sand for this trade, 7,500 rupees.
Right. Now you combine this with your trade setup. Let's say you want to buy Tata Motors futures at 393.65, and you decide your stop loss level, your exit point if you're wrong, is at 390.
So the difference is 3.65 rupees per share.
Correct. And let's say for Tata Motors futures, one lot controls 1,500 shares. So your risk per lot is 3.65 rupees times 1,500 shares, which is 5,475 rupees.
Okay, the risk on one lot is 5,475 rupees.
Now, you compare that to your maximum acceptable loss per trade, which was 7,500 rupees. Since 5,475 is less than 7,500, you can comfortably take one lot. If the risk per lot had been, say, 9,000 rupees, this method would tell you not to take the trade, or to find a tighter stop loss, or trade a smaller position if possible.
I see. It forces you to calculate the risk before entering and only proceed if it fits your rule.
Precisely. Many professional traders stick rigorously to a 1% to 3% risk per trade rule. It keeps losses manageable and prevents that recovery trauma.
That feels very practical and controllable. Is there anything even more mathematical?
Well, there is Kelly's criterion. This is a formula developed by John Kelly Jr. back in the 1950s, originally for Bell Labs looking at telephone line noise, but it was quickly adopted by gamblers and traders.
Kelly criterion, what does it do?
It attempts to determine the optimal fraction or percentage of your capital to bet or invest on each opportunity, assuming you have a positive edge, to maximize long-term capital growth.
Optimal bet size based on your edge. Sounds powerful. How does it work?
The basic formula is Kelly percents equals is WA, 1 WR, where W is your historical winning probability, the number of winning trades divided by the total number of trades.
Okay,
And R is your average win-loss ratio, the average profit from your winning trades divided by the average loss from your losing trades.
Payoff ratio. Okay.
So let's say you analyze your trading system's past performance. Out of 10 trades, you had 6 winners and 4 losers. So W equals 610 equals 0.6 or 60%.
Win rate 60%.
And let's say your average winning trade made 4,532 rupees, and your average losing trade lost 3,274 rupees. So R equals 4,532, 3,274 equals about 1.38.
Okay, winners are bigger than losers on average.
Now you plug W 0.6 and R 1.38 into the Kelly formula. Kelly perceives 0.6, 1.38. That comes out to roughly 0.31 or 31%.
Kelly says 31%. What does that mean? Risk 31% of my capital on the next trade. That sounds huge.
Exactly. And that's the big caveat with raw Kelly. Directly applying a high Kelly percentage, like 30% or even sometimes 70% if the edge is strong, is often considered way too aggressive for practical trading. A string of losses at that size could be devastating.
So how do people use it realistically?
A common practical modification is to use Kelly in conjunction with the percentage risk method we just discussed. You might use a Kelly percentage to scale how much of your maximum risk you deploy. For example, if your absolute maximum risk per trade is set at 5% and your Kelly calculation for your current system is 30%, you might decide to risk 30% of that 5%.
30% of 5%. That's 1.5%. Much more reasonable.
Exactly. It allows you to be optimally aggressive within your predefined risk limits, betting a bit more when your edge seems stronger, higher Kelly percent, and less when it's weaker, but never exceeding your overall risk cap. It's about using Kelly to modulate your risk, not dictate it absolutely.
That's a fascinating bridge between the theoretical edge from Kelly and the practical risk control of percentage risk.
Okay.
So we have the math for risk, the strategies for sizing, but you mentioned earlier maybe the most critical element is understanding our own minds.
Indeed.
Let's really delve into some of those common trading biases that can just completely sabotage even the most well-laid plans, the best math. Have you heard that story? Maybe apocryphal, about someone's grandfather buying shares in MRS, the tire company, way back in the 90s.
I think I have, yes. Worth a fortune now.
Like, apparently 20,000 shares bought then were worth something like 128 crore rupees recently. That's over 15 million US dollars. How on earth could someone hold on to an investment like that for decades, through all the crashes and booms?
Well, the common inference from that story, whether it's totally true or not, is quite telling about psychology. The grandfather likely just put them away and essentially forgot about the investment.
You forgot he owned millions.
Effectively, yes. By forgetting, he avoided the constant temptation to sell during smaller rallies or panic during dips. He bypassed all the mental noise. This perfectly illustrates the idea that often our imaginations, our biases, our interpretations of market noise prevent us from achieving optimal outcomes, like just holding a great long-term investment.
Wow. So ignorance was bliss and profit. What's one of the big biases that stops us from being rational?
A major one is the illusion of control. This often crops up when traders use incredibly complex charts loaded with dozens of indicators, lines, oscillators.
The spaghetti chart?
Haha, exactly.
Yeah.
The sheer complexity can make the trader feel like they have total control. Like they possess some unique insight that nobody else does. You hear things like, based on my analysis, this stock is definitely not going to go above 500.
But the market does what it wants.
Precisely. Markets have a large degree of randomness, especially short-term, and we simply cannot control all outcomes. Believing you can is an illusion. The antidote: stay relentlessly focused on results and statistics. Know the actual odds of your setup working based on past data, not just how convincing your chart looks.
Focus on the probabilities, not the predictions.
Okay, what's another one?
Recency bias. This is where we give far too much weight to recent information or events, making us effectively turn a blind eye to past events or critical facts that might contradict the latest news.
Can you give an example? Sure. Imagine a popular coffee chain, Cafe Coffee Day, CCD, gets hit with really bad news about tax evasion and corporate governance issues. The stock tanks. Then, maybe it has one small green candle, a tiny up day after the massive fall.
Little bounce.
A friend holding the stock might see that single green candle and say, "See? It's recovering. I knew I should hold on." They're focusing only on that most recent tiny uptick, completely overweighting it, while ignoring the much larger, more significant negative news and downtrend. Recency bias is blinding them.
So the antidote is?
The antidote is to consciously take cognizance of the wider picture, the longer-term context, the fundamental backdrop. Don't let the latest tick or news headline dominate your entire perspective. Zoom out.
Zoom out. Good advice. Okay, I know I personally struggle with this next one. Anchoring bias.
Ah, yes. Anchoring or focalism. It's a classic cognitive bias where we get fixated or anchored on the very first piece of information we receive about something, often a price.
Yeah, like wanting to buy a stock only if it drops back to a specific price you first saw or thought of.
Exactly. There was this stock, Sundaram Clayton. I remember wanting to buy it around 270 rupees, but it started moving up, went to 300, 350, and I just kept waiting for it to come back to my anchor price of 270.
Did it?
Nope. It kept going, turned into a massive multi-bagger, one of the greatest investment opportunities I missed, simply because I was anchored to that initial price. My mind had created this price conflict, and I couldn't adapt.
So what's the cure for anchoring? It feels really hard to shake off.
It is hard. There's no magic bullet, really. The only cure is constant self-awareness and deliberate critical thinking. Actively question why you're fixated on that initial price or piece of information. Is it still relevant? Has the situation changed? You have to consciously challenge your anchors.
Challenge the anchor.
Yeah.
Okay. What about getting stuck in old ways of thinking?
That relates to functional fixedness. This is a cognitive bias that limits us to seeing or using an object or even a process only in the way it's traditionally used. The classic example is needing a weight, having a hammer nearby, but only seeing the hammer as a tool for nails, not as a potential weight.
The screwdriver spoon analogy you mentioned earlier, how does that apply to trading?
Well, imagine you have an overnight futures position, say in the Nifty Index, using NRML order type, which blocks a certain amount of margin. Then, during the trading day, you see a great intraday opportunity in TCS stock, but you think, oh, I can't take that trade. My margin is blocked by the Nifty position. That's functional fixedness, seeing the NRML position only in its overnight capacity.
Is there an out-of-the-box solution?
Yes. The out-of-the-box thinking overcoming functional fixedness is realizing you can often temporarily convert that overnight NRML position to an intraday MIS position during the day. This frees up a significant chunk of margin, potentially allowing you to take the TCS intraday trade. Then, before the market closes, you convert the Nifty position back to NRML to carry it overnight again.
Whoa. Okay. That's thinking flexibly about the tools.
Exactly. It's about not being fixed on the standard function, but seeing how tools or positions can be used differently to achieve a goal.
Very clever. Okay, another big one. Confirmation bias. Seeking out only what confirms what we already believe.
Yes, a huge one in trading and investing. It's our natural tendency to look for, interpret, and remember information in a way that confirms our pre-existing beliefs or hypotheses while ignoring contradictory evidence.
So if I'm bullish on Tata Motors,
Right. If you're already bullish and then some positive news comes out about their electric vehicle sales, you'll likely seize on that news as definitive proof you're right. See, this confirms it. The stock is going to the moon.
and ignore maybe other news about chip shortages or competition.
Precisely. You might downplay or completely ignore other realities that don't fit your bullish narrative. The confirmation bias filters your perception. The antidote here is rigorous critical reasoning. When you see confirming news, actively ask yourself, so what? Does this really change the big picture? And crucially, what evidence disproves my view? Let me actively search for it.
Seek disconfirmation. Okay, last one. This sounds painful. Attribution bias.
It can be painful to confront, yes. Attribution bias is our tendency to attribute our successes to our own internal qualities, our skill, our intelligence, our hard work. I made money because I'm a great trader.
But our failures.
But we attribute our failures to external factors beyond our control. I lost money because the broker system lagged, or the market was irrational, or that news event was unfair. It's about taking credit for wins and blaming losses on outside forces.
So we avoid taking personal responsibility for the losses.
Exactly. It protects our ego in the short term, but it completely prevents learning from mistakes in the long term. If you always blame external factors, you'll never identify or fix the flaws in your own strategy or decision-making process.
What's the antidote for this one?
Okay.
How do you force honesty?
The single best antidote is maintaining a detailed trading journal religiously, documenting not just the entry and exit points, but why you took the trade, what your thinking was, what happened, and honestly assessing the outcome, what you did right or wrong. Reviewing this journal regularly provides unbiased, factual insight into your actual trading behavior, cutting through the ego-protecting attribution bias.
The journal as the mirror. Powerful. Wow, okay, what a deep dive that was. Seriously, we've covered so much ground, from the really intricate math of portfolio risk, variance, correlation, optimization, all the way to these subtle but incredibly powerful tricks our own minds play on us through biases.
We certainly have.
It feels incredibly clear now that successful participation in the markets isn't just one thing. It's truly a blend of that quantitative analysis and deep self-awareness, and you need both.
Absolutely. Understanding how risk is quantified, knowing how to potentially optimize a portfolio for your specific goals, and then critically recognizing the common psychological biases that can cloud your judgment. These are invaluable tools. They work together. And remember, knowledge is really most valuable when it's truly understood and then applied. Just knowing the formulas isn't enough. And that critical thinking we talked about, questioning assumptions, challenging biases, it's just essential in today's world of information overload.
Couldn't agree more.
And, there's always more to learn. Seeking out multiple perspectives, continuing to educate yourself, it only enriches your understanding. No single module or conversation has all the answers.
So true. Always learning. Okay, so maybe a final thought for everyone listening. Thinking about your own financial decisions, maybe even decisions outside of finance. Which of these biases we discussed, illusion of control, recency, anchoring, confirmation, attribution, which one do you think has influenced you the most?
That's a tough question to ask oneself, honestly.
It is. And then, thinking about the practical side, how might a more disciplined approach to position sizing, like that percentage risk method, or maybe even using Kelly's criterion carefully, how might that fundamentally change your approach to the opportunities and the challenges you face in the market?
Lots to chew on there.
Definitely something to think about. We really hope this deep dive helps you navigate the markets and maybe even your own decision-making with a bit greater confidence and clarity. Until next time, keep learning, keep questioning, and keep deep diving.